Hello and welcome to this week's market call.
Latest news.
As always, let's begin with some latest news. Firstly, looking at the trade war, we are still receiving some mixed signals. China, for example, has demanded that the US revoke all tariffs and said that there were no talks in reaching a trade deal. On the other hand, President Trump has said that talks were underway. Furthermore, China has exempted some US imports from its 125% tariffs, some products such as pharmaceutical products, and they are considering further exemptions for other products as well. However, the potential for trade deals being struck between the US and other countries still remains unclear, although it could have potential significant impacts on energy markets. On the economic impact side of things, the IMF has cut its 2025 growth forecast for major Asian economies and the global economies overall by cutting the global growth forecast by 0.5%. Now, as you may have heard, there was a major power outage in Spain, Portugal, and some regions of southern France. The cause of this is still yet to be determined, but as soon as we have more information about this, we will, of course, let you know.
Crude oil and LPG.
Moving along to the crude oil price evolution, when looking at both WTI and Brent for last week, we do see quite a sideways price evolution, although further along the curve, such as 2027 and 2028, we do see slight increases. On the more bullish side, the US Treasury has added new sanctions targeting Iranian companies in order to reduce Iran's revenue stream, although the US is currently in talks with Iran for their nuclear program. Furthermore, a potential ceasefire between Russia and Ukraine still remains on the table, which could, of course, have a bearish impact on oil prices as Russian sanctions could be removed or eased due to it. Furthermore, OPEC Plus will meet on May 5th in order to discuss potential increase in production starting in June. This is additional to the current unwinding of the production cuts that were started in April. Furthermore, the weakening US dollar has made it cheaper for countries with holders of other currencies to buy US dollars and therefore US oil, and therefore this could increase oil demand, especially in the short term.
Natural gas.
Looking at gas price evolution, overall we see very strong bearishness, especially when looking at the calendar 26 product with a decrease of 7.6% last week. However, starting more on the bullish front, we are expecting some Norwegian maintenances happening this week, although they should be quite short-lived. However, we are currently seeing quite low LNG demand coming from Asia, and therefore this means more LNG availability for European countries. And we are expecting above average temperatures overall in Europe, hence lowering gas heating demand. We of course also have news on the storage front. So as you can see, we are clearly below last year's levels. However, we have rebounded, let's say, as the spread between last year's levels and this year's levels have shrinked, where now we are just about 23% below last year's level, whereas 2 weeks ago we were at around 26% below. The main reason for this decrease in spread was due to the very strong net storage injections that we're currently seeing. Last year at this point, we experienced very high demand, as you can see on the right-hand side of your screens there, due to a cold spell, which increased gas heating demand quite substantially. So far this year, we have not seen this, and therefore this has allowed the spread between last year's gas storage levels and this year to reduce.
Coal.
Moving along to the coal price evolution, we experienced quite a bearish week for both API2 and API4 with decreases of 5.6% and 3.2% for the calendar 26 product respectively. Now, we still see very strong stock levels for both China and India, very important consumers of coal in the world, of course. We also saw, as mentioned before, very bearish gas prices, which therefore improve the profitability of gas-fired power plants, hence reducing coal demand. Furthermore, of course, the US tariffs and the potential for a trade war, or the current trade war, does reduce economic expectations and therefore coal demand as well. On the more bullish front, low Rhine water levels at the moment could potentially disrupt European supply, although that still remains to be seen. And furthermore, Chinese stimulus package, the recent stimulus package could improve economic numbers, economic data in China, and therefore increase demand for Chinese coal.
EU and UK emission allowances.
Moving along, for emission allowance price evolution, overall last week we saw quite a neutral or a sideways trend for both the European carbon allowance and the UK carbon allowance. Although overall, when we look at the past 12-week trend, we clearly see an increase for a UK carbon allowance, mainly due, as mentioned in the previous weeks, due to the talks, the rumors of wanting to recouple the country's emission trading scheme with the European trading scheme. The European carbon allowance, however, for the past 12 weeks have decreased quite substantially, mainly due to a tariff impact, which, as mentioned before, is expected to reduce economic growth and therefore reduce fossil fuel demand as well, and therefore carbon demand because of it. Looking at investment fund positions, for European carbon allowances, we are now essentially at net neutral position. Whereas for UKA futures, we do see net long positions continue to increase week on week.
Electricity.
Moving along to electricity price evolution, looking at German price evolution, the more liquid market, we see that they followed mainly gas price evolution, with the calendar 26 product decreasing by 3%, or 3.07% to be more exact, which is a trend that we can see for most other European countries on the left-hand side of your screens there. When we look at generation sources in a bit more detail, we can clearly see on the right-hand side, French nuclear generation has decreased in the past month due to some maintenances, although this is relatively in line with the previous years. And so far this year, we have seen French nuclear generation being quite strong, again, compared to 2024. When looking at a mixture of wind and solar generation, although we did see weaker wind generation overall, especially now, we do see quite a strong downtick there. However, the impact has been softened by the very strong solar generation that we have seen compared to previous years so far. And therefore, once we compare both of them, overall, we are seeing wind and solar generation being relatively in line with previous years. This, of course, especially solar generation, will be very important during the summer, as of course it takes much more of an important role in the European power mix. Looking at the coal generation at the top right-hand side of your screen, I did want to emphasize the very strong coal generation that we experienced in Q1 of 25 due to the lower temperatures and higher need for coal generation. However, we have seen coal generation easing quite strongly now, which is in line with previous years. And hopefully we will keep seeing this, depending, of course, on renewable generation as well, as renewable generation was quite lacking in the first few months, especially in February of 2025. Looking at hydro reservoir levels, as you can see, both the Nordic countries and the Iberian countries are seeing very strong hydro levels, which of course is quite a bearish factor on energy prices. And finally, looking at guarantees of origin price evolution, last week overall we did see decreases for all years, and this is mainly due to the windier conditions are expected to happen this week, and also due to the relatively strong solar generation year on year that we have been seeing, as explained previously. Thank you very much for joining the call, and we wish you all a great week.